Think inflation is yesterday's news? Brace yourself. July just unleashed a shock that could hit your wallet and investments fast. Everyone expected a quiet summer for prices, but July blindsided Wall Street. U.S. producer prices soared by the biggest margin in over 3 years, jumping 0.9% when experts had only bet on a tiny bump. That is not just a blip. This spike, triggered by fresh tariffs, climbing costs, and global economic tremors, could ripple straight to your bottom line. The measure tracking what companies pay to make our everyday products shattered all forecasts. TradingView News called it, U.S. producer prices increased by the most in 3 years amid a surge in the costs of goods and services. Seeking Alpha confirmed, the U.S. Producer Price Index rose 0.9% month over month, trouncing the 0.2% expected. Here's why you cannot tune this out. When producer prices leap this high, higher costs quickly hit your grocery bill, gas pump, or monthly expenses. If you are an investor or planning your budget, missing these warning signs could drain your savings and blindside your future. Your purchasing power, investments, and financial security are all on the line, while those who act now may protect or even grow their wealth. Let's break down exactly what caused July's inflation shock and uncover how the fallout may be even bigger than the headlines suggest. First, let's look at exactly what drove producer prices to surge so unexpectedly. The details reveal how quickly things can change and what you need to watch next. Ever wondered if there's an alarm bell for rising prices before they hit your wallet? This July, that bell rang loud, and if you don't pay attention, you could lose more than just spare change. Let's dive into the Producer Price Index, or PPI, and why it's a crucial signal for anyone who wants to protect their money. The PPI measures what businesses pay for goods and services before those costs reach you, the consumer. Think of it as your financial smoke detector. When it blares, inflation danger is close behind. Here's why July's numbers are sending shockwaves through the economy. After a brutal run of inflation between 2021 and 2023, recent months had finally shown signs of cooling. Most analysts felt confident. Inflation seemed beaten, markets were ready for interest rate cuts, and everyone expected smoother sailing ahead. But July flipped the script. The Producer Price Index for final demand shot up nearly 1% in just 1 month, the steepest rise since March 2022. Analysts had only expected a tiny uptick, and June's number was completely flat by comparison. Reuters reports, the Producer Price Index for final demand jumped 0.9% last month after being unchanged in June. This wasn't a fluke in one sector. Prices for both goods and services soared, with services like trade and transportation seeing especially sharp increases. According to the Economic Times, U.S. producer price inflation surged in July to its highest level since 2022, driven by a significant increase in services costs. Even food prices climbed dramatically, putting more pressure on household budgets. So, what's behind this sudden surge? The main driver? Tariffs. Fresh and renewed tariffs on imports such as steel, aluminum, and dozens of other products are pushing up costs for American businesses. Those higher expenses are now flashing in the wholesale data, and it's only a matter of time before they hit consumers at checkout. The impact is being felt everywhere, from Wall Street to your local grocery store. Seeking Alpha warns, producer prices rise most since March 2022 in July, blowing past estimates. Suddenly, hopes for quick interest rate cuts are fading, throwing both investment plans and household budgets into uncertainty. If you ignore these warning signs, you risk falling behind as your paycheck loses buying power and your investments face new threats. But if you understand the signals, you can take action to defend and even grow your financial future. The stakes are real. Adapt now or pay the price as inflation returns. But what exactly is the Producer Price Index, and why does it matter so much for everyday people and investors alike? Let's break it down so you can spot the warning signs before they hit your bottom line. Don't look away. Something big is brewing beneath the surface, and missing it could cost you more than you think. This isn't just another quirky data point. There are powerful economic forces at work right now that could reshape your wallet and your future. In July 2025, a shockwave hit the U.S. economy. Producer prices surged by nearly 1% in a single month. That is the sharpest increase since 2022. Here's the twist. Experts had only forecast a tiny uptick, but the jump was more than 4 times their prediction. This spike is not just a statistic. It's a warning sign of a chain reaction that could squeeze every American's budget in the months ahead. What sparked this sudden leap? Tariffs are back in a big way. President Donald Trump's sweeping taxes on imported goods, everything from steel and aluminum to everyday household items, have driven up costs for companies bringing products into the country. Yahoo Finance reports, U.S. wholesale inflation surged unexpectedly last month as President Donald Trump's sweeping taxes on imports are pushing costs higher. This means U.S. businesses are now paying more for raw materials and finished products, and those costs will not stay hidden. They get passed along to you. But tariffs are only the opening act. The real strum includes soaring service costs. Every rung of the supply chain, from shipping and logistics to insurance and warehousing, is getting pricier. Al Mayadeen English notes, U.S. producer prices rose 0.9% in July, the fastest pace since 2022, driven largely by services and food costs, as Trump's renewed tariffs intensified inflationary pressures. This is not a blip in one sector, it's a widespread rise, making inflation much harder to tame. Layer on the global chaos, geopolitical tensions, stubborn supply chain snarls, and wild weather are all driving up the costs of essentials like food and fuel. CNN Business warns, costs were sharply on the rise for producers and manufacturers in July, a sign that higher prices could soon filter down to American consumers. Price hikes at the factory or farm don't stay put. They ripple out, pushing up what you pay for groceries, household necessities, transportation, and even healthcare. The collision of these forces, tariffs, shifting policies, and global shocks has caught many experts flat-footed. Instead of the cooling inflation they expected, a fresh wave is building, threatening to derail hopes for quick interest rate cuts or relief at the cash register. If you ignore these signals, you risk watching your purchasing power shrink and your investment returns fall behind rising prices. Planning for big-ticket goals, from buying a home to saving for retirement, suddenly becomes a lot more uncertain. But those who spot the shift early could protect their savings or even profit while others are caught off guard. The stakes are real. Missing this inflation wave could mean losing ground financially just when you need stability the most. So what could this new inflation surge mean for the Federal Reserve's next moves? And how might it reshape your financial future? Let's break it down. Miss this, and the cost could hit your wallet before you even notice. What if inflation keeps running hot? The warning signs are screaming louder than ever. In July, U.S. producer prices surged by 0.9%, the largest leap in over 3 years. This spike, amplified by new tariffs and rising costs for goods and services, is fanning the flames of inflation that could spread through every sector, from manufacturing to your local grocery store. Here's the danger. When wholesale prices climb, that pain almost always lands on everyday consumers. Ignore this, and you risk getting blindsided as interest rates, investment returns, and even your job security swing out of balance. Wall Street was betting that inflation was tamed, with hopes pinned on a string of Federal Reserve interest rate cuts. As one Yahoo report put it, July's inflation shock emboldened traders to boost bets on interest rate cuts from the Federal Reserve in coming months. But after this latest surge, those hopes are evaporating. Matt Weller from StoneX warns, some people were saying that we could see 3 consecutive 25 basis point rate cuts. But if anything approaching this level of inflation is in place, it seems like we might be looking at more of a max of 2 interest rate cuts, and even that might be questionable. Translation, if high inflation sticks, the Fed might have no choice but to keep rates elevated for much longer. The stakes ripple out fast. Higher for longer rates mean mortgages, car loans, and credit cards all stay more expensive. If you were counting on quick relief, you could be waiting much longer than you planned, and paying more in the meantime. For investors, the landscape just got trickier. Some speculated the dollar would jump on the inflation news, but analysts urge caution. Pepperstone analysts note, the market is very much likely to remain all in on the idea of a September cut, at least until we hear from Powell at Jackson Hole next week. If inflation keeps climbing, even a September cut could disappear. For everyday Americans, this means real pain at the checkout line, at the gas station, and in monthly bills. Paychecks won't stretch as far, and if businesses start passing on higher costs to customers, the squeeze will only intensify. Ignore these inflation signals, and you risk watching your purchasing power erode, your investment returns shrink, and your financial plans unravel. But those who act by rethinking spending, shifting investments, or locking in rates now could protect what they have, or even come out ahead. So, how can you spot the early warning signs before they hit your bank account? Let's break down the signals you need to watch for, and what to do next. Here's how the smart money is already adapting, and what you can start doing today. With inflation pressures heating up again, doing nothing is not an option. Failing to adjust could mean not just missing out on gains, but watching your savings lose real value. Let's start with your personal finances. Review your monthly spending and look for places where costs are most likely to rise, especially groceries, utilities, and imported goods. Lock in fixed-rate deals where possible and consider buying in bulk before further price hikes roll in. For investors, the landscape is shifting fast. A stronger dollar, as we saw after producer prices surged, may benefit some assets but hurt others. The Australian dollar, for example, fell despite positive jobs news, showing that currency swings can quickly erode overseas investment returns. Look at how big players are moving. Corporate treasuries like MicroStrategy and Block Incorporated continue to buy Bitcoin, as reported by Yahoo. Bitcoin just hit a fresh record this year, supported by new institutional money flows and regulatory changes, including allowing crypto in retirement accounts. Adding a small allocation to alternative assets like Bitcoin or commodities can help hedge against inflation. But remember to manage risk. These markets move fast. For your investment portfolio, consider rebalancing towards sectors that tend to outperform when inflation is high, such as energy, materials, and consumer staples. Diversifying globally can help, but beware of currency risk. A stronger greenback can eat into foreign returns. On the cost of living front, inflation protection starts at home. If you rent, try to negotiate longer leases to lock in rent levels. If you have debt, especially with variable rates, see if you can refinance to fixed rates before borrowing costs rise. And if you are planning big purchases, like appliances or vehicles, you might want to move sooner rather than later. In short, the people who come out ahead in times like these are the ones who act early, not late. Ignoring these warning signs could mean you are left reacting to higher prices and fewer choices. Let's recap the stakes and break down how you can position yourself to stay ahead as these trends unfold. July's shock is a warning, not a one-off. The next moves are yours. In July, U.S. producer prices leaped by nearly 1%, more than quadruple what experts predicted, marking the biggest surge since the year 2022. This spike was not just a blip. It was fueled by rising costs in both services and goods, with new tariffs lighting a fire under import prices. What we are seeing now is not the end of inflation, but the signal that a new wave could be about to crash. For months, markets believed that the Federal Reserve would slash interest rates quickly, confident that inflation was under control. But the data tells a different story. Producer price inflation is now at a 3-year high, and higher costs for businesses almost always find their way to consumers' wallets. If you choose to ignore these warning signs, you are gambling with your purchasing power, your investments, and your future. Complacency means letting outside forces decide the fate of your finances. But those who recognize what is coming and act decisively can shield themselves and maybe even turn risk into opportunity. Inflation is not dead, and pretending it is could be your biggest mistake. July's surge is a wake-up call. Will you adapt and protect what you have, or will you wait and hope things blow over? In the next section, we'll break down practical steps you can take right now to navigate this new inflation reality and keep your financial goals on track.